today we are going to complete this chapter about relevant cost analysis for decision making. Relevant cost analysis is a decision-making technique used in businesses to determine true cost difference between alternatives. It is also called incremental, marginal, or differential analysis. Analysis models include only relevant costs that differs between alternatives being considered, and these costs are typically broken into variable and fixed components. Variable costs change with the level of production or sales volume, and fixed cost remains constant regardless of the level of production or sales volume. In order for a cost to be relevant, it must be future, cash flow, and incremental. Relevant cost is a future cost. Past or sunk costs are considered irrelevant. Relevant costs are cash costs. Non-cash costs such as depreciation or amortization expense are considered non-relevant. Relevant cost is incremental cost. It changes with the activity being considered initiation or increase. It's often important for businesses to distinguish between relevant and irrelevant costs when analyzing alternatives, because considering irrelevant costs can lead to unsound business decisions. In addition, ignoring irrelevant costs in analysis can save time and effort. Relevant costs include prospective incremental costs and opportunity costs. Prospective incremental costs are future costs that only incurred when an activity of relevance has been initiated or increased. Opportunity costs are the missed opportunity when choosing one alternative over another. Opportunity costs should be considered in making decisions in order to make sure that the company choose the most favorable option. Non-relevant costs include sunk cost and non-cash cost. Sunk costs are past costs already incurred and can't be recovered. It is the sum already paid in the past and that is no longer relevant for decision making about the future. Because the sunk cost will remain regardless of any decision being made, these costs are not included in the relevant cost analysis. Non-cash costs such as depreciation and amortization costs are not included in the relevant cost analysis as well, because depreciation, for instance, does not represent cash outflow, does not represent real cost. It is about dividing the historical cost of fixed asset over its useful life in order to recognize the decline in the value of the asset over time. That's why it is recorded in the business records. It is considered artificial cost, does not represent the cash outflow. That's why it is not included in the relevant cost analysis for decision making purposes. Relevant cost analysis can be applied to specific decision problems. In this chapter, we consider 5 decisions, and in the previous session, we have explained the first 3 applications: setting prices of products, accepting or rejecting special orders, adding or eliminating products, segments, or customers. In this session, we will review what have been explained and carry on with the rest of applications: processing or selling joint products, and finally make or buy decisions. When applying differential analysis to pricing decisions, each possible price for a given product represents an alternative course of action. The sales revenue for each alternative and the cost that differs between alternatives are the relevant amounts in these decisions. Total fixed costs often remain the same between pricing alternatives, and that's why it should be ignored. It is considered irrelevant in the context of making pricing decisions. In selecting a price for a product, the goal is to maximize net income. The goal is to select the price at which total revenues exceed total costs. Total future revenues exceed total future costs by the greatest amount, thus maximizing net income. A high price is not necessarily the price that maximizes net income. If a company sets a high price, the number of units sold may decline as customers switch to lower priced competitive products. The customer may choose to purchase another product from a competitive firm set as at lower price. Thus, in the maximization of income, the expected volume of sales at each price is as important as the contribution margin per product unit. So, in the making pricing decision, considering expected volume of sales at each price is very important. Considering the contribution margin per product unit is very important as well. So, in making any pricing decision, management should seek the combination of price and volume that produces the largest total contribution margin. This combination is often difficult to identify in real world because management may have to estimate the number of units that can be sold at each price. So it is a matter of estimation. Expected number of units to be sold in the future needs management to make estimates. That's why it may be hard in real world to identify the best option. ABC company estimates product demand to be 15,000 units at $6 selling price per unit, 12,000 units at $7 selling price per unit, 10,000 units at $8 selling price per unit, and 7,000 units at $9 selling price per unit. Fixed cost of $20,000 per year are not affected by the difference in the demand level. Variable cost is $5 per unit. The question that we need to answer is what price should be set for the product? $6, $7, $8, or $9? So selling price per unit and sales volume are the relevant amounts for pricing decisions. We have four options, either to sell the product at $6, $7, $8, or $9. Variable cost per unit will be the same under each option. It will be $5. Contribution margin per unit is the difference between selling price per unit and variable cost per unit. It will be different under each option. It will be either $1, $2, $3, or $4. The demand level will be different under each selling price. When the selling price is $6, the demand level is 15,000 units. When the selling price per unit increases to $7, the demand level decreases to 12,000 units. When the selling price per unit increases to $8, the demand level declines to 10,000 units, and when the selling price per unit increases to $9, the demand level further declines to 7,000 units. By multiplying contribution margin per unit by the expected sales volume, we can obtain total contribution margin. Total contribution margin will be different under each option, and it is the highest when the selling price per unit is $8. When the selling price per unit is $8, the contribution margin per unit is $3, the demand level is 10,000 units, and the total contribution margin is $30,000. This amount contributes to recovery of fixed cost. $20,000 fixed cost will be the same under each option. It doesn't differ between alternatives. And the remaining amount is net income. So $30,000 total contribution margin contributes to covering $20,000 fixed cost, and the remaining amount is $10,000 net income. So the company should select the price of $8 per unit because this price generates the greatest total contribution margin and net income. So the highest price is not the best option. We need to consider the demand level under each price. We need to choose the combination of selling price and sales volume that generates the highest contribution margin and net income. And this is true for the third option when the selling price is $8 per unit. Relevant cost analysis can also be implemented to make decisions regarding accepting or rejecting special orders. Relevant cost analysis can determine whether companies should sell their product at prices below regular levels or even below unit cost. When operating at less than full capacity, management should seek additional business. Such additional business may be special orders at a discount. Management may decide to accept a special order at prices lower than regular levels or even lower than average unit cost if the differential revenues from the additional business exceeds the differential costs. A Braves company produces and sells a single product with a variable cost of $8 per unit. Fixed cost is $48,000. The selling price is $20 per unit, and the company expects to produce and sell 5,000 units. That's why the expected net income is $12,000. The company receives an order from a foreign distributor for 3,000 units at $10 selling price per unit. This $10 selling price per unit is a discount price. It is not only half of the regular selling price per unit, $20 regular selling price per unit, but also less than the average cost per unit. The average cost per unit is $17.6. However, the $10 price offered exceeds the variable cost by $2. The contribution margin per unit for the special order is $2 per product unit. If the company accepts the order, net income increases to $18,000. In specific, if the company accepts the order, revenues will increase to $130,000. Net revenues will increase by $30,000 in effect, 3,000 units multiplied by $10 selling price per unit. Variable cost will also increase by 60%. Sales volume has increased by 60%. That's why variable cost should also increase by 60%. Variable cost will increase to $64,000. Total fixed cost don't exceed with the special order. It will remain the same. It will be $48,000. It will not be affected. At the end of the day, net income will increase to $18,000. So revenues will increase from $100,000 to $130,000 if the special order of 3,000 units at $10 discount price is accepted. If the special order is accepted, revenues will increase by $30,000. Variable cost will also increase from $40,000 to $64,000. Variable cost will increase by $24,000 because sales volume increases by 60%. Variable cost also increases by the same proportion. contribution margin will increase from $60,000 to $66,000. So contribution margin will increase by $60,000 if the special order is accepted. Fixed cost will remain the same under the two options. If the special order is accepted or rejected, fixed cost will be $48,000. That's why fixed cost is not incremental cost. It is irrelevant cost in this case. Net income accordingly will increase from $12,000 to $18,000. Net income will increase by $6,000 if the special order is accepted. So the net benefit of accepting the order is $6,000. That's why the special order should be accepted. Relevant cost analysis is also useful with respect to making decisions related to adding or eliminating product, segment, or customer. Periodically, management has to decide whether to add or eliminate certain products, segments, or customers. Relevant cost analysis is useful in this decision making because income statement of the company does not classify costs with certain products, segments, or customers. Thus, companies need to reclassify costs as those that the action would change and those that it would not change. If companies add or eliminate products, they usually increase or decrease variable cost. Fixed cost may not change. Management base decisions to add or eliminate products only on the differential items, that is the costs and revenues that change. Bookstore is considering eliminating its art supplies department. The department is generating $100,000 annually. $80,000 variable cost is assigned to the department and $30,000 fixed cost is assigned to the art supplies department. So cost incurred is higher than revenues generated by $10,000. The department is making losses of $10,000. Should the bookstore eliminate the art supplies department? So if the art supplies department is closed, the business will lose $100,000 revenues. The reduction in cost would be only $80,000 variable cost directly related to the art supplies department, and the $30,000 fixed cost are general bookstore fixed cost allocated to the department. These fixed costs would continue to be incurred and wouldn't be saved by closing the art supplies department. So the art supplies department has been contributing $20,000 annually towards covering the fixed cost of the business. Consequently, the elimination could be a costly mistake unless there is a more profitable use for the vacated facilities. So the net benefit of keeping art supplies department is $20,000, and the decision should be not to eliminate the art supplies department because it contributes $20,000 towards covering the fixed cost of the business. So if the department is closed, revenues generated will decrease by $100,000. Variable cost will also decrease by $80,000, and the contribution margin will decrease by $20,000. The difference between revenues and variable cost represent the contribution margin. So the art supplies department has been contributing $20,000 annually towards covering the fixed cost of the business, towards covering the $30,000 fixed cost. Accordingly, its elimination could be costly mistake unless there is more profitable use for the available facilities. So if the business closes the art supplies department, it will lose the $20,000 contribution margin that can. If the company has a profitable alternative use for the vacated facilities, the potential income from the alternative represents an opportunity cost of retaining the product segment or customer. Assume that the bookstore could use facilities currently occupied by the art supplies department to open a new department to display and sell personal computers, printers, and software. This new department would contribute $35,000 to the bookstore's income. So the relevant costs in the decision to retain the art supplies department are $115,000, $18,000 variable manufacturing cost, and $35,000 opportunity cost of not opening a new department, while the relevant revenues are still $100,000. Therefore, the bookstore has a net disadvantage in keeping art supplies department because it loses $15,000 compared to the computer department. The art supplies department has $20,000 contribution margin. In specific, the art supplies department generates $100,000 sales revenues. The variable cost is $80,000. The difference between revenues and variable cost represents the contribution margin. Art supplies department generates $20,000 contribution margin. The personal computer department is expected to generate $35,000 contribution margin. So the additional income generated by the personal computer department is $15,000. So the bookstore has a net disadvantage in keeping the art supplies department because it loses $15,000 compared to the computer department. Sometimes two or more products result from a common raw material or production process. These products are called joint products. Companies can process these products further or sell them in their current condition. Management can use differential analysis to decide whether to process a joint product further or to sell it in its present condition. Joint costs are those costs incurred up to the point where the joint products split off from each other. These costs are sunk costs and are not considered when deciding whether to process a joint product further before selling it or to sell it in its condition at the split off point. Pacific Paper produces two paper products, A and B, from a common manufacturing process. Each of the products could either be sold in its present form or processed further and sold at a higher price. Data for both products follows. For product A, the selling price at the split-off point is $10. Cost for further processing is $6. Selling price after further processing is $21. For product B, selling at split-off point is $12. Cost of further processing is $7. And selling price after further processing is $18. In order to make decisions related to whether to sell or process further joint product, we need to consider different revenues of further processing and the cost of further processing. With respect to product A, different revenue of further processing is $11. Cost of further processing is $6, and the net advantage of further processing is $5. With respect to product B, different revenue of further processing is $6. Cost of further processing is $7 and the net disadvantage of further processing is $1. Based on this analysis, Pacific Paper should process product A further to increase income by $5 per product unit. The company should not process product B further because that would decrease income by $1 per unit sold. Companies use this same form of differential analysis to decide whether they should discard their byproduct or process them further. Managers also apply relevant cost analysis to make or buy decisions. Make or buy decisions take place when management must decide whether to make or purchase a part or material used in manufacturing another product. Management must compare the price paid for a part with the additional cost incurred to manufacture the part. When most of the manufacturing costs are fixed and would exist in any case, it's likely to be more economical. It's likely to be more feasible to make the part rather than buying it. Assume that Small Motors Company manufactures a part costing $6 for use in its toy automobile engines. Cost of components are materials $3, labor $1.50, fixed overhead cost $1.05, and variable overhead cost $0.45. Small motor company could purchase the part for $5.25. Fixed overhead cost would continue even if the part were purchased. The added cost of manufacturing amount is 30 cents per unit. This amount, the 30 cents per unit, is less than the purchasing price of the part. Therefore, manufacturing the part should be continued as shown in this analysis.